Welcome to 2026, guys. My name is Elder. If you do not know me, we've been trading for about 10 years. I'm making a brand new updated tutorial on how to start day trading right now from 2026 on forward, when the markets have never been better ever since Trump took over. So I want to make sure we make this clear, straight to the point. So right after you watch this video, you can start trading the very next day, fucking tomorrow. I'm going to show you guys everything we've done so far, the results I've had with the exact same strategy you guys are about to learn in this video. My number one goal is to make sure when you're done watching this shit, you can start to take action, right? You don't have to do another mentorship, you don't have to watch another course, another YouTube video. You can start taking action right away. Because that's the only thing that's stopping you in 2026 from getting to where you want to be at, is taking action. Anything and everything is possible. It's all up to you. You are your own biggest enemy, and especially in trading where there's no fucking inventory, no clients, no warehouse, no boss, no bullshit. It's you versus you. It's you and your time. That's all it is. So the only thing standing in your way from getting nice places to live, wearing nice watches, or whatever the fuck you want, is literally you, yourself, your time. So without further ado, let's get right into it, guys. You can please do me something, a big ask. I know. You can Venmo me $4,000. No, I'm just kidding. But what I want you guys to do, right, is pretend you paid $4,000 to watch this fucking video.
All right, little midgets, it is time, man. The time y'all have been fucking waiting for. Now you're gonna be hearing me say this quote right here a lot, man. There's an average of 20 trading days in the month. We only need 5 of them to get a fucking payout. Keep that shit in your head, because the setups we're gonna be talking about today, from start to finish, right? You don't see them often, but when you fucking see them, they're A+ as fuck, and they will be hitting. So 5 out of days of the whole month. Be patient. The less is more, man. One and done is my motto. I'm about to get that shit tatted on my forehead, so y'all fucking listen to it. One and done is the way it works. But here's how future trading works, by the way, guys, if you guys are not familiar with it. Now, I want to stress this out. What futures are and how they work aren't important, bro. Like, what the future contract is doesn't matter. You care about how you use this shit to make money. But it is a way to move or to trade major movements of the market, like the S&P 500 and NASDAQ, without actually owning any stock. So you're simply predicting whether price will go up or down, and you make or lose money based on that movement. Now, we're going to start with a little bit of the beginner stuff, guys, not go super in depth in the beginnership. We're going to go over some of it. So if you are completely new, at least this will make some sense to you. But when we get a little bit deeper and deeper throughout the video, we're going to go through the very advanced shit. So I'm not going to have this shit be a little cherry picking bullshit, going back in replay mode. I want you all to be able to use this shit in a live market. Right? Most people teach you shit you can fucking use if you're like looking back past data, just scrolling through the market, cherry picking shit. This is shit you can use tomorrow. You're trading the market index, not individual companies. You can make money in both directions, up or down. Markets move very fast, especially at the New York Open, and you only need a small amount of capital because futures offer leverage plus prop firms, right? And again, all of this matters, not that much, because it doesn't matter. Most of this matters. Like, what doesn't matter is what it is. Again, this doesn't matter. You can make money in both directions. That matters. So markets move fast. This matters for us, especially. We'll get to that a little bit later. And you only need this amount of capital because of futures and prop firms. That shit does matter. And our only job is to identify high probability setups and manage risk. We're going to keep it super simple. But why we trade futures? Why not anything else? There's no PDT rule, no cash requirement, no scanning for stocks. We only trade ES and NQ, guys. And something I do want to show you guys, if you do let me, is my performance using this exact setup going back in June 2024, July 2024. I'm just going to scroll through all this month using the same system you guys are about to be learning here today, the same exact system. And now we're in January, haven't done too much, taken 4 trades the whole month. We're up 35 racks. No, can't complain. Slow month, not going to lie. But that being said, right, everything we just saw was live. All the trades were live in front of hundreds of people. So they aren't random bullshit numbers. They're back tested. They're tracked. They are legit. There's no news-driven randomness. We know when most of the time news comes out, unless Trump drops some tariff shit. Pure price action, volume, and order flow. You can trade 1 to 2 hours per day and be done. That's what we want to do. One and done, and be done as fast as we possibly can. It's the cleanest way to trade the market, right? There's no hype, no guessing. It's just clean price action. Now, how prop firms work, this is like my bread and butter, because what this is going to allow you to do, guys, is actually scale from $10,000 months to $100,000 months, right, to $50,000 months. Copy trading prop firms and how they are and what they work. So you pay a small fee to activate the challenge. I'm going to move this right here. Follow the rules, hit your profit target, collect your payout. That's pretty much all you have to do, right? For example, is Top Step. I'm not sponsored by these firms or anything like that. I don't have any kind of affiliate code or anything like that. I'll leave some prop firms down below if y'all are interested in it. But Top Step, I'm not sponsored by them. I have no codes. I don't make money off them at all. They're just a really good prop firm that's been around for a very long time. They always pay out. This most beginner-friendly one, if y'all are starting out. I'm not sponsored by this one, and that just tell you something. I recommend them because they're super beginner-friendly. Rules are simple. You make 6%. Don't lose more than 3%. Consistency, so there's a 5-day minimum to get your payout, right? And first payout could be up to $5,000. We'll break this down a little bit more depth as we move forward, but that's what it is. It's pretty simply pay. It's actually cheaper now. It's $80 a challenge, not $200. So they made it cheaper on y'all, actually. Copy trading. This is the secret fucking sauce, guys. So you can copy trade within prop firms, right? Top Step, Apex, blah, blah, blah. You can get 5 Top Step accounts, you get 20 Apex accounts. But you can also use trade copiers to let you trade prop firms together, right? So Apex, Top Step, you know, one of the futures traders, etc. And why this matters, guys. So for perspective, this is one of the market opens we had on ES a couple weeks ago. And each dollar the ES moves counts as $50 per contract. So ES went from 66.40, right, to 67.10. It made a 70-point move in about 30 minutes. Why should you even give two shits about this? Let's say you only caught 10 of those points, remember, and it moved 70. Let's say you only caught 10 of them. That would be $1,000 on one account in less than 10 minutes. If you got 10 of those points out of 70, 10 points literally came in about 5-10 minutes. 5,000 schmeckles if you had 5 accounts being copy traded. Remember that $80 Top Step account? You can do 2 ES contracts on it. $20,000 plus if you had multiple prop firm accounts being copy traded together in only 10 fucking minutes in only one trade. Just think about it. And again, guys, right? Each account only costs you about $50 to $500. And Top Step account is like fucking $80 for this return. I want to implement this into your head so you understand right now you might not be seeing a lot of profits from one account. You might be seeing a couple $100 here and there, so it might be demotivating. Think about the end goal. Think about what you can do once you have all these account copy traders together. One trade, 10, 20 grand a month off of one fucking trade. So keep that shit in your head. The less is more, man. I'm going to be saying that multiple times because I know a lot of y'all there are revenge trading. A lot of y'all over there are oversizing. Let me take a sip of coffee. Hell yeah. And I don't want y'all to do that because I did that for a long time and it fucked me over for a very, very long time. Now, why prop account versus live? Why? Why prop from accounts? Well, why can't I trade my live money? I'll tell you exactly why. With $200, you can take a $5,000 payout very fast while following the proper risk rules, right? With a $200 live account, turning it into $5,000 is nearly impossible unless you gamble or take a year to do it. And, you know, $200 to $5 grand in a year is a pretty crazy return in my opinion. So unless you got, you know, $500,000 in a broker account, prop firms are the way to go. Now, again, I talked about how I'm not going to be going through the beginner shit here, but I kind of want to use this right here as an example because we're going to talk about a lot about order flow in this video. And this is a normal candlestick chart. This does not give you much data, which is why order flow is so key. It tells you where price was in the past and where price currently is, right? If you don't know what a candlestick chart is, I have plenty of videos on my channel, but I'll break this down for you. I recommend you watch this video full before you check out any of my other videos, but I have plenty of videos on my YouTube channel going over everything you fucking need. Basically, right, you select the time frame. So right now, we're on the 4-hour time frame. That means every single one of these little boxes and lines is a 4-hour time period, right? You have time here on the x-axis and price on the y-axis. So at this specific time period, price was whatever it is at right here. At this time period, price was at right here. Now, each box represents a 4-hour time period. What a green box shows you is the bottom of the box is where price opened. The top of the box is where price closed. The high of the box is where price was the highest in this 4-hour time period. The bottom of the box is where price was the lowest in this 4-hour time period. And if it's red, it's just the opposite, right? Red means the price closed lower than it opened. So if it's red, price opened at the top of the box, closed at the bottom of the box, was the highest wick, was the lowest wick. That's all the candlesticks try to show you, where price was in the past and where price currently is. It's not enough data. It's not a lot of data in my opinion. But this is how you actually find a high probability setup. A little bit of a glitch here, but I'll walk y'all through it. Find the overall trend of the market on the 4-hour. This is going to be the direction of our trade. Find key supply and demand levels, right? This is where we'll be placing the actual trade. Find profit target invalidation levels. People call these stop loss levels. I like to call them invalidation levels, and you'll see exactly why. Where you will get out of the trade. Use order flow for your entry. When you'll actually press buy and sell to take the trade. Use a risk to reward table to match your risk to reward to your win rate. We'll go over that in depth. Track and journal, review your progress weekly. That's it. That's what you got to fucking do, guys. Now, keep in mind, right? The market will only move in 3 different directions. You'll either be in an uptrend, moving up, right? It'll either be moving sideways in a sideways trend, making equal highs and equal lows, or moving down, a downtrend, making lower lows and lower highs. The first step to this book, into this whole setup, this whole story, to every single strategy out there actually, is identifying the current trend of the market. Why do we want to follow the trend, right? The average time we stay following a trend is much greater than the average time we spend breaking or forming a new one. I recommend you guys open up a chart, zoom into that chart, right? And just start fucking scrolling. Like I'll show you right now. Go to the 4-hour time frame. Look at the average time we spend continuing a trend, right? Than we do breaking or forming a new one. It's much greater. So what we're doing is leaning probability on our side. If we're following the trend, remember that saying, the trend is your friend? It really is, because if you play with the trend, you're putting probability on your side. That's why we follow the trend. So for example, for me, I classify a bullish market. This is all on the 4-hour time frame, by the way, guys. I'm gonna make my face a little smaller here. I know y'all love seeing me, but so y'all can see the whole screen here. The bullish market, 3 higher highs, 2 higher lows. Bearish market, 3 lower lows, 2 lower highs. Balanced market, 3 equal highs, 3 equal lows. So this is how I classify what kind of market we're in, and it's on the 4-hour time period, right? Making 3 higher highs, 2 higher lows, 3 lower lows, 2 lower highs. That's how I classify the market we're in. Now the where do we place trades, right? We only want to take our trades in supply and demand for a very, very specific reason. We want to be done trading about 1 to 2 hours per day. That's it. And to do this, right, we want our entry to be where we have seen massive historical big and fast moves. To make these moves, you need hundreds of millions of dollars to make this kind of move in a chart, right, or any kind of market. So step 1, drawing supply and demand. I'm going to show you guys exactly how to do it. We're going to identify a big move up or down on a 30-minute time frame. We're going to find consolidation or a neutral candle before the big move. This is where all the orders are being filled. And we're going to confirm this level with order flow for demand. Massive move up. Consolidation before the move. The bottom of the box is going to be the bottom wick. Top of the box is going to be the top body. Then you draw the box. I have like 6 videos on my channel going over supply and demand zone, so check those out if this is a little confusing to you. For supply, big move down, 30-minute time frame. Remember, consolidation before the big move. Top wick, bottom body. So this is actually opposite for supply. Draw your box. Easy. My 3-year-old kid could do this, guys. Come on. Now, how you play with the overall trend. The trend is your friend. If it's a bullish market, we're only going to be taking trades where we're buying, we're betting on the market going up, right? That means we're taking longs off demand or longs off break retest of supply. I'll show you all some examples here in a second. If it's a bearish market on the 4-hour time frame, we're only taking trades that we're selling, betting on the market going down. Typo here again. Shorts, I'm not a words person, I'm a numbers guy, so excuse the typos. But shorts off supply or shorts off break retest of demand. And if it's a balanced market, we're only going to take trades in the range. So shorts off the top of supply or longs off the bottom of demand. We're going to avoid every single breakout we see. It's an unclear structure. If you're looking at the longer time frame in the 4-hour and you don't know what the fuck is going on, and I don't know what the fuck's going on a lot of times, I have no shame in saying that. I'm proud to say that. If a trader tells you they know what the fuck's going on 24/7, they're lying to you, because I don't know what's going on a lot of times. And I'm okay with that, but what I do is I just avoid everything. I sit on my ass. Remember, I'm going to repeat this 5 more times. 5 good days is all we need to get a payout. There's about 20 of them in a month. Now, for a bearish market, we want to go for shorts off supply or break retest of demand. Simple. Bullish market, long off demand or break retest of supply. Simple enough, right? Y'all following along? Put it down in the comments below if y'all following along at this point. Put down below fucking pepperoni hot dog slice, and then I'll know you're a G. But now we zoom into the 5-minute time frame. 5-minute trend needs to shift into the 4-hour time frame, right? Or into the 4-hour trend. This only matters for bounces off supply and demand, because if it's a breakout, the 5-minute will already match the 4-hour trend. And I'll show you examples so it makes more sense to you. But for shorts, right? On the 30-minute time frame, we tap into the supply level. Then we zoom into the 5-minute time frame. So we want to see the market put in a new low and a lower high. And we want to enter off that lower high. Now, for longs, right? Hit demand on the 30-minute time frame. And they want to zoom into the 5-minute time frame and look for that higher high and higher low, and our entry will be on that higher low. Simple enough, guys. It's something that I want you to do every single time to take a setup. I know you're going to be there patiently waiting, and it's going to, take a little bit longer, but this increases your win rate significantly. When are we going to get out of the setup? When are we going to get out of the trade? Super, super key. I need to know this before I even press buy and sell. So before we even talk about the entry triggers, we're going to talk about when to get out. So step 1 is find invalidation. This is where your thesis will be invalid, right? It'll either be at swing low for longs, at swing high for shorts, and we'll show you all these examples, right? Step 2 is find the profit target. If we're right, where do we get out? I need to know this before I fucking even press that buy and sell button. Before the market even opens, I want to know this shit. We'll use VWAP for this. I'll show you what that is and how to get it. Or the last high or low. Now, step 3, this will be on a 30-minute time frame. Step 3 is make sure your entry and validation and profit target aligns with the risk reward table. This is going to be based off your win rate. We're going to go over all of this, but number 3 is the most important part. I don't care how perfect, how beautiful, how sexy a setup looks. If number 3 isn't checked off, you avoid the setup and you wait for the next one. Super, super key here. Let's move on. Now, invalidation, what most people like to call their stop loss. For me, for shorts, will be at the swing high, and for longs, will be at the swing low. Now, why, right? For example, on the shorts, if my thesis is the market selling off and making new lows, right, continue to sell off, then this will get invalidated if we put in a new high. So if I'm short here, I'll put my stop loss at the high because I think the market's going to sell off and give me a new low. That's where my take profit level is. So if we come in and put in a new high, I'm wrong. We just put in a new higher high. My thesis is most likely incorrect, so I want to get the fuck out at the high. Most people fuck this up because they want to get out of the trade at how much money they want to lose. Let's say they're in here, they want to lose $100. They put their stop loss in the middle of this consolidation here. They get stopped out, the price goes to their TP. The market does not care how much money you want to lose. It cares about how much, just cares about price. That's simply put, it cares about price and volume. So if you put your stop loss on invalidation levels and not how much money you want to win or lose, you'll have a much better chance of staying in the trade long enough for it to actually end up playing out. Now for longs, it's a swing low. So if I'm in long here, I think the market will put in a new high. If we come in and put a new low, I'm wrong. No, I'm going to get the fuck out right here. Now, invalidation stop loss for shorts, right? It will be at the lower high. And for longs, it'll be at the higher low. Sorry, I did that backwards. But this is for break retest setups, basically. So play a break retest for longs. We broke retest, right? I'm thinking, my thesis is this will be the higher low. So if we come in and make a new low, right, I'm wrong. I want to get the fuck out. Same thing for shorts. We break the band, retest the band. I'm saying this is the lower high. So if I'm wrong, I want to get the fuck out. Very simple, guys. Very elementary type stuff. But let's talk about VWAP. Only indicator I use, and it's used by massive institutions. It shows the volume weighted average price of the market. Now, this is blue line, basically, right? It's an equation that spits out a blue line. That's the only indicator I use. I use it for my exits always because indicators are lagging behind price. They're always behind, so I never use them for entries. But for my exits, I use it because it's a highly well-respected level. Institutions use this equation, basically, but this just spits us out a blue line. Quickly show you how to get it. So I'm going to show you how to get it on TradingView, but they have this on basically every single different trading platform out there. Basically, what I do is you go onto indicators, you type in VWAP. You open up VWAP. I already have it on there, but I guess just added it in again. So I already have it on here. Right here for me, it's a blue line. You change the color to whatever you want to change it to. But I have high in session low, high plus low plus close divided by 3, standard deviation. That's all I do. I don't plot any bands. I just care about the VWAP line. That's literally it. For take profit levels. Now, for shorts, right? If VWAP is below us, we target VWAP. If VWAP is above us, which is actually a good indication that our thesis is correct, we target the last low. Very easy. For longs, if VWAP is above us, we target VWAP. If VWAP is below us, another good indication for longs, we target the last high. Very, very easy. The win rate. So the setups we're about to go over today that we started going over already have a win rate of 68%. All of them do. Now, keep that in mind when we're talking about this risk to reward table. Now, this is basically showing you what your win rate is, right? And then what you're depending on what your win rate is, this is how much you should risk per trade. So if you have a 40% win rate, 2 to 1 means that to make $200, you can only risk $100. You can be profitable with a 20% win rate. What that means is if you're risking $100, you better be sure you're making $500 to offset that. With our win rate, we only need a 1-to-1, meaning that if my TP's at $100, my stop loss has to be at $100. To do that in the long run, I'll be profitable. You got to think of trading as a probability game. That's all it is. It's a long time frame probability game. What this means is simple, right? You can flip a coin 10 times. You might get heads all 10 times, right? You flip that coin 5,000 times, it'll be closer and closer to 50-50. The more you flip it, the closer and closer to 50-50 it gets. Now, with that being said, you have to have a large enough flips, right? Large enough sample size, large enough amount of trades for luck to be removed from the equation. You flip a coin 10 times, it could be heads. You're lucky, right? It's all luck. You flip that shit 5,000, 10,000 times, it's going to be closer and closer to 50-50. This is where probability works out for you. It's a law of large number. Now, probability has no memory. That's why you need a large enough of a sample size for luck to be removed from the equation. But that being said, you're gonna hate me for this. I want to make sure I move my face here so I can see exactly what's going on this picture here. I'm so bored. I actually made this picture myself. Thank you. I only want you to take 2-to-1s. Why? It's going to increase your profitability by at least 2x. Remember, there's 20 trading days in a month, man. You need 5 of them. I go repeating it again. You only need 5, where the less is more. So if you wait for the 2-to-1s, even though you only need a 1 to be profitable, especially with copy trading prop firms, you will succeed much faster. I guarantee that. So this will be you at the beach on your laptop with your cup of coffee. Like, fuck, man, I'm bored. I'm waiting for my A+ setup. I need 5 of them. That's it. I can get a payout. Hopefully this is you. Quick visual representation for those of you that are visual learners. The distance from your entry, so you entered here to take profit, has to be double the distance from your entry to stop loss. That's all it means. All it means. Now that you know where to take a trade, where to get out, and what direction of the trade, when do I press buy and sell? And this is where order flow comes into the picture. To understand order flow, got to understand a couple things first, baby. Market versus limit orders, bid versus ask, passive versus aggressive. You get that shit locked in, you'll be ready to move. But I'm going to break it down for you. You're welcome. And Bookmap is basically the tool we use to read all of this, read order flow. It's not the best, or to me personally, it's the best tool, but there's plenty of tools out there that let you read that information. I'm not sponsored by them. I don't have a discount code. I'll show you how to get it. But Other than that, I have no discount code. And again, it's pretty simple, guys. All you got to do, that's not how you spell bookmap.com. Bookmap.com, baby. And you just buy it here. You could pay for your own data. If you have a prop firm, you can connect it to this Bookmap and get data from them. A little pricey. I'm not sure how much it is actually. I paid the lifetime fee, so it's not super cheap, but it's also not crazy expensive. It's probably the cost of a prop firm account, to be honest. But market versus limit orders is the first thing we have to get out of the way before we actually get into this lesson. So market orders are our entry orders. Limit orders are going to be our exit orders. So I like to use a lobster analogy for this, basically. So if you want to buy ES right now, right? ES right now is priced at whatever, 6884. If you want to buy it right now, you'll get filled at whatever the current trade price is. You'll get filled right away. We use these for entries, and I like to use a lobster analogy. So a lot of y'all, when you go out to a restaurant, go to a nice restaurant, you want to order lobster. Everything else on the menu has a price. Steak $50, chicken $50, but lobster says market price. And that means the lobster obviously changes prices during different seasons. So whatever the current price of lobster, if you want lobster right then and there, you'll pay that market price, whatever it is. Limit order, for example, is let's say you're cheap and you know lobster is cheaper in October. So you only go to the restaurant in October because lobster will be this exact price. It'll be cheaper. Basically, we use this for exit orders. This is what all the smart money uses. So if you want to buy ES only when it hits $6,000, right? Only when it hits $6,000, you'll set a limit order all the way down here, wherever it is. And one that gets tapped, it'll get filled. If it doesn't get tapped, you won't get filled, right? You will only get filled if it hits $6,000. And we use these for profit targets and stop loss orders. Super, super simple, guys. Super, super simple. The next thing you have to understand before we get into the nitty gritty is the bid versus ask. Now, the spread is irrelevant. It's just the difference between the bid and the ask because we're trading ES futures. The spread is so fucking thin, so slim that it doesn't really matter. It's irrelevant to us. Bid is the maximum price that buyers are willing to pay at a given time. It reflects the demand side of the market. Ask is the minimum price sellers are willing to accept. It represents the supply side of the market. The difference between both of them is the spread. But obviously, right, buyers want to buy cheaper and sellers want to sell at a higher price. Duh, right? The captain obvious here. This is very key. Very key. Buyers, think about it. When you're buying a house, you want to pay as cheap as amount of fucking possible. When you're selling a house, you want to fucking sell that shit for the most amount fucking possible. Think about it. Just think about that. But this is how we tell who's being aggressive and who's actually in control. How? How do we do that? By watching the market orders coming into the market. So aggressive sellers will sell at the bid. They will sell at a cheaper price. They're willing to get out of their position or enter a short position at a cheaper price, right? They want to do it right then and there. So they're willing to go cheaper. They're willing to go down. Let's say you're in debt. You have a fucking car you want to sell. If you put it on the market for 10 grand, it's not selling. You need that money tomorrow or you're going to jail. You will sell that shit for much cheaper. You're being fucking aggressive. You want to get rid of that shit to pay your bills so you don't go to jail, right? This is what aggressive selling is. Aggressive buyers will buy at the ask. They will buy at a more expensive price. Hence, they're being aggressive. Now, if you see a car, right, on the market and everybody fucking wants that car. Super nice car. You've been waiting to buy it for a long, long time. You just finally saw it. You're ready to buy it right now. There's bids. There's offers everywhere for it. The demand's going up, 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 and up. You see that buyer in person. You're like, damn, bro, I want this car for you right now. You're going to offer him a pretty expensive, high price because you want it right then and there. You don't want to have the chance of it, going up or disappearing for a while, somebody else buying it. You want to buy it then and there. You're being aggressive. So aggressive buyers are willing to pay a more expensive price to get in right away. Remember, these are all market orders. Hence, being aggressive. Now, the limit orders, right, sitting in the market, all the limit orders, all the passive participants, this is the real liquidity, the magnet. And we can actually use Bookmap to see all the limit orders that are sitting in the market. Now, how do we see these orders? Bookmap, baby, Bookmap. Bunch of other tools, but Bookmap takes the throne by far. Now, I am going to repeat myself here. Bookmap is how we see everything that's going on, right? And there are a bunch of other tools, but by far, this takes the throne in my personal opinion. It shows you just what a candlestick chart shows you, right? It gives you the price on the y-axis, time on the x-axis, and it shows you, that's why I overlay the candlesticks here. It shows you exactly what a candlestick chart would show you, but you also get so much more detail in depth, right? So you see, again, price on the y-axis, time on the x-axis, but you also get the red balls, if that's what you want to call it, show the aggressive sellers. These are sellers that are settling at the bid, and the bigger the balls are, the more volume of them there actually are. The green balls are the aggressive buyers. So these are buyers buying at the ask, right? The aggressive buyers, and they're represented by the green balls. The bigger they are, the more volume there is. Now, all the orange lines you see are passive participants. These are limit orders sitting in the market, stop loss, take profit, entry orders that big guys use. Now, to make a line like this on our chart, it costs hundreds of millions of dollars. These are like legit fat ass positions. And if it's above price, they're passive sellers. And if it's below price, they're passive buyers. Now, again, a little more of a zoomed in visual representation for you guys here. We have passive sellers above us, passive buyers below the current price. The current price is right here. It's highlighted. red bubbles, right? Or not red bubbles, green bubbles, green balls, aggressive buyers, red balls, aggressive sellers. How does this actually end up helping us in the long run? So we can actually see where all the liquidity is sitting. We can read the relationship between passive and aggressive participants, and we can pinpoint our entries. For example, right here, we push into supply and sold off. You're looking at a candlestick chart, what the fuck does this tell me? You look at Bookmap, you'll see, well, there's a fat wave of passive selling sitting in that supply zone. So we didn't fill all of it, right? There was more passive sellers than aggressive buyers, and the market then started to move down. This is how we read the relationship, right? So buyers are in control, and the market will move up if there's more aggressive buyers than passive sellers, or there's more passive buyers than aggressive sellers. Sellers are in control, right? The market will move down if there's more aggressive sellers than passive buyers, or more passive sellers than aggressive buyers. Tongue twister here, but it's all common sense. If the market's balanced, there's an equal amount of passive and aggressive sellers, or an equal amount of passive sellers and aggressive buyers. Common sense here, right? If there's more aggression on one side and less passive on the other side, the side who has more will be in control. This is kind of how we read who's currently in control of the market. I'll give you all some visual examples so you see what I mean. But how do we use this for our visual entries? There's actually 2 steps to our entry triggers that we're about to show you right here. Remember, the entry trigger will be on the higher low, but we want to start looking at order flow when we start to get into that key level. To do this, we need to understand a couple things: exhaustion, absorption, and aggressive follow-through. Now, aggressive sellers and buyers dying out is exhaustion. Basically, you see the market move up, right? This is an example of aggressive buyers dying out, and the green circles, right, are getting smaller and smaller and smaller. So the market moves up, kind of tell we clear these offers here, clear it here, because there's a big red circle that ends up taking all of them up, and then there's more bids above. We pull into this massive wave of an iceberg right here, and then the buyers just disappear. They just go away. They get smaller and smaller and smaller. This is exhaustion. One side just getting smaller and less volume. This is awesome because when you read overall volume in market, a lot of times I would just look at volume bars, but you can't really tell much from volume bars because when it comes to the market, there's 2 sides to every single transaction. There's a buyer and there's a seller. So, when you look at volume, it's just fucking volume. There's no buy side volume, there's no sell side volume. But when you look at this kind of volume, you could see, well, the volume of aggressive buyers are getting weaker as we're in supply, indicating a potential reversal. Absorption is the same thing, but basically kind of just flip-flopped. It happens when passive limit orders stop aggressive market orders from pushing through a specific price level. Now, all this is, like for this example, there's more passive buyers than aggressive sellers. Right here, you see a massive seller hit this pretty big wave of passive buying. There's still passive buyers left over, so the market then reverses. So there was not enough aggressive selling to break through this wall. There was more passive buyers than aggressive sellers, even though there was a massive sell-off here. All those offers got absorbed. All those aggressive sellers got absorbed by passive buyers, and the market then reversed because there's more passive buyers here than there was aggressive sellers. Now, for longs, first step is you need to see sellers getting exhausted or sellers getting absorbed, right? And the entry is going to be on the higher low. So you need to see either absorption from sellers or sellers basically just disappearing. See, we're moving down, clearing these offers. We see all these big sellers. And as soon as we get to this low right here, where do they go? Where are the sellers, right? Where do they go? For shorts, right, you need to see buyers getting exhausted or buyers getting absorbed. A little cutout here, I'm not sure why I did that. So at that higher, when we actually get into supply, you need to see massive absorption, still leftover passive offers, or basically buyers just going bye-bye, disappearing. Now, your entry is after you spot this. Again, everything has to make sense. You have to be in supply and demand, has to be with the 4-hour structure shift. We have to have the 4-hour trend, you have to have the 5-minute structure shift. Everything has to make sense into one beautiful play. The longs, at the higher low, you're going to wait for an aggressive buyer to fill a passive sell offer and make a bid above, and you press buy. Excuse my typo. So you see the exhaustion, you wait for this buyer to fill aggressive offer and make a bid above, you press buy. Shorts, right? At the lower high, you wait for an aggressive seller to fill a passive buy offer and make an offer below, you press sell. So wait for it to fill below, you press sell. Let's go over some examples. For longs, 4 hours bullish, price approaches demand on the 30-minute time frame. We zoom into the 5-minute time frame, right? We wait for that new high, wait for that higher low. Do we see exhaustion or absorption at the lows? Yes, indeed we do. Sellers get smaller and smaller. They go bye-bye. Now, this whole way down, we didn't get a single buyer filling anything. As soon as we get that buyer filling something on this higher low, what do? Wait for a bit above. We're in. Now, this is the most important part. This is the trump. I like to call this the Big Daddy Trump, right? Let me make my face a little bit smaller here. Make sure entry is twice as far from view up than swing low. So right when you spot this entry trigger, we press buy. Is the distance from the stop loss to entry to take profit to VWAP at least half, right? So is this half of the take profit? Yes, it is. Perfect, we're in. If it's not, I don't care how perfect everything else is, you don't fucking take the trade. Don't take it. You just fucking wait. Now, for shorts, bearish. You just hit supply, 4 hours bearish, 5-minute time frame, and make that new low, make that lower high. We see exhaustion. Buyers getting weaker and weaker and weaker. And I want you all to cherry pick this shit, by the way. I want you all to see exactly what I'm showing you now. The less is going to be more. You see an aggressive fill here, a bid below. You see an aggressive fill here, here, a bid below. So there's a bunch of entry triggers here. You can get on this first one if you want to. You can get on the second one. It doesn't really matter. So it's just all you need to see. Now, does this give us a 2-to-1? Let's see. The low is actually right here. So if you move this up a little bit, it actually is a 2-to-1 exactly. So off of entry where we saw this right here, actually later entry, distance from take profit, which is right here, to stop loss is at least 2-to-1. Yes, sir, it is. We take the fucking trade. These are the rules I want you to follow, okay? Max, 1 trade per day. Wait for every single confirmation, baby. If you have a red week, you size down. I size down significantly after a red week, especially only 1 trade per day, because most of you guys watching this don't have enough discipline and enough confidence to be able to recover after a loss. So a lot of traders that I teach, especially, I get to see all their data. I stock them. And most of them, after 1 loss, their second trade is almost always a loss and almost always sets them up for tilt for a bad time because they don't have the discipline enough to shake off a loss. They take a loss and they're fucking pissed. They want to make that shit back because they can't lose yet. They can't lose well enough. So as you get deeper into your setups, into your confidence, you'll be able to take more trades per day. But I highly recommend most of y'all benefit from just taking 1 trade per day. Don't risk more than 20% of your drawdown per trade. So if your drawdown on a prop firm account is $1,000, don't risk more than $200 of it per trade. Track every single trade you take. Now, I don't care if you go on crazy tilt. Like if you go on crazy fucking tilt and you, let me just go here, right? Crazy tilt and you revenge trade and you take like 1 billion trades. I don't care if you do that. Make sure you track all of them. Because if you don't track all of them, you're never going to learn. I used to do this thing back in the day, right, where I would break my rules. I would tell myself tomorrow would be different. I wouldn't track the trades I broke. I'd be like, let's just forget this day happened. Let's move on. I wouldn't change anything. I wouldn't fix anything. I wouldn't track anything. And I was expecting a different outcome. It's the definition of insanity. So if you end up breaking your rules, track it, write it down. You'll start to see these triggers that set you off. Just like entry triggers, there's triggers that I see in my students that set them off for a tilt day. A lot of you guys watching this video are super good at winning. You go on massive win streaks. You can take really good trades. But you have 1 or 2 bad days that you go on tilt because you can't accept a fucking loss, or you get, distracted, you miss a setup, or you get wicked out right before it goes to TP, or you get a tick from TP and you get stopped out and you go on fucking tilt. You track that shit. Identify your tilt triggers, and it's the only way to actually improve is by going through your data to see what you're doing wrong so you can fix it. Because if you don't know what you're doing wrong, it means you're not tracking. How the fuck are you going to fix shit? Next thing I want you guys to do is start with 1 account first. A lot of you guys are going to jump into prop firm accounts, right? Start buying 1 billion fucking accounts, copy trading all of them without even have ever gotten a payout before. You're going to get fucked, right? You're going to end up losing a lot of money. So use 1 account, $80, get your first payout, and use that payout to then buy more accounts. Now, at that point, your initial risk is going to be so small, and you have all these accounts in your name because of that 1 little payout you actually ended up getting. But that's all for me, guys. I'm done yapping here. I hope you guys enjoyed this video. So, a little bit long, about 30-35 minutes to get you guys through everything you need to start getting your payouts exactly tomorrow. So leave it down below in the comments if you guys think, after watching this video, was that 4K investment I told you about worth it, right? That fake 4K y'all paid me to watch this shit. Put it down below in the comments. What do you think you guys will be able to start fucking trading this shit tomorrow, or at least looking at the market tomorrow? No matter how in depth I go on this will never actually click unless you fully jump into the market and you fully start applying this shit for yourself. And again, everything I told you, you can definitely start doing tomorrow, right? Just like I did, right? I did all this shit on my own, learned on my own. It took me 3 years to make any amount of money because I was on my own. I highly recommend you start trading with a group, with a friend, with a community, with a family, whatever it is. Trade together. I'll leave my Instagram down below in the comments, guys. Please follow that shit. Please subscribe to me. Please do a like. It's all I fucking ask of you. I got nothing else to ask of you. All it takes, it's free from you, and it makes me fucking keep going and making this shit for you guys. I appreciate y'all. See you in the next one.